Welcome to the Taxation Chapter 9 tutorial. For Chapter 9, the main topics that we're going to focus on are other income and deductions. And some of these other income and deductions include moving expense deductions, childcare expense deductions, spousal and child support, register education savings plans, tax-free savings account, and then we're going to wrap up and look at non-arm's length transfers. So let's talk about moving expenses. Now, moving expenses is a deduction for individuals under 3C when calculating net income for tax purposes. Now, moving expenses are only allowed when there is an eligible relocation, moving for new work or employment within Canada greater than 40 kilometers. Now, this also applies if you're moving for school or if you're finishing school and moving for new work. That would also apply as well as an eligible relocation. Now, only certain moving expenses are eligible. House hunting trips are not deductible. If you were moving from Vancouver to Calgary and you went to Calgary to look for a house, but you weren't actually starting work yet, that could be considered a house hunting trip. That amount would not be deductible. Now, if you're acquiring a new residence and there are certain costs involved with buying that new residence, once again, let's say in Calgary, those costs would only be deductible as moving expenses if you were selling an old residence in your former location, let's say Vancouver. If you were renting in Vancouver and then you bought a new house in Calgary, the cost of buying the new house would not be deductible because you did not sell a house in your old Vancouver location. Also, meals and lodging for up to 15 days near your old or your new residence would be allowed as well. Let's say you were renting in Vancouver and you had to move out at the end of the month, but you had to still stay in Vancouver to wrap up a few things. Then the cost of, let's say, putting yourself up in a hotel and those meals would be deductible because it's close to your old location for up to 15 days. Now, this is a cumulative 15 days close to your old and your new location. Transportation costs, hiring movers to move your belongings from Vancouver to Calgary, those would be deductible, as well as the actual physical move to travel from the old location to the new location. Now, on the next slide, in terms of meals, there is a simplified method. Rather than having to save all your receipts for your meal costs, let's say you're driving from Vancouver to Calgary and there's meals along the way, rather than have to save all those receipts, you can use a simplified method of a flat rate of $17 per meal times 3 meals a day to a maximum of $51 a day. Now, this is per individual within the family, so if there was a husband and wife, it would be double that amount, $51 per individual. Now, there's also a simplified method in terms of vehicle expenses. If you're driving from Vancouver to Calgary for this move, rather than have to once again keep track of all your gas receipts, you can use a simplified rate per kilometer of travel, but this would be using the rate from the originating province. Every province has a different rate per kilometer, so if you're moving from Vancouver to Calgary, you would use the BC rate. Now, the moving expenses are only deductible against income from the new work location. So if you move from Vancouver to Calgary, you have all these eligible moving expenses. You can only deduct them up to the amount of income you earn in the Calgary new work location. Now, if the employer reimburses you for any of these moving expenses, those amounts are considered a taxable benefit. The only exception is if you were to, let's say, sell your old residence in Vancouver and you experienced a loss and your employer reimbursed you for some of that loss, then only 1/2 of the amount your employer reimbursed you for, that is over $15,000, would be taxable. Moving on to the next slide, let's talk about childcare expenses. Childcare expenses also a deduction under 3C. Now, the childcare expenses may only be claimed by the lower income spouse. So if there's a couple, only the lower income spouse could claim the childcare expenses. There are some exceptions. If the lower income spouse is attending school or is in hospital or in prison or has a physical or mental infirmity, then the higher income spouse could claim a limited amount. But let's just sort of focus on the lower income spouse first. Now, the lower income spouse can claim the lesser of 3 amounts. the actual amount paid, the sum of what's called the annual child care expense amounts, and 2/3 of the lower income spouse's earned income. Now, the earned income definition is in your textbook, so make sure you review what that includes. Now, the earned income calculation for child care expenses is different from the earned income calculation for RRSP purposes. So they're both called earned income, but the definition for child care expense earned income and RRSP earned income is different. So let's talk about what this annual child care expense amounts are. So there's a set amount per child that the government has set. What they're saying is that if the child is under 17 at the end, under 7 at the end of the year, then that set amount is $8,000. If the child is between 7 and 16, that amount is $5,000. Now that also includes dependent children over 16 that have a mental or physical infirmity. Now, if the dependent child is eligible for the disability tax credit, they have a disability that is quite severe that impairs greater than 90% of their day-to-day activities, then the annual amount goes up to $11,000. So these are maximum thresholds that the government has set per child. Now, moving on to the next slide, we did say earlier that the higher income spouse could make a claim as well. And if the higher income spouse is able to make a claim, there's a fourth limit. In addition to those 3 limits that we looked at in the previous slide, the fourth limit is the number of weeks the higher income spouse is eligible to make a claim times what's called the periodic child care expense amounts. Now, the periodic child care expense amounts is 1/40th of those annual amounts that we just looked at. So remember, if a child was under 7 at the end of the year, the annual amount was $8,000. 1/40 of that is $200. 7 to 16 years of age, $5,000 was the annual amount. 1/40th of that is $125. And if the child is eligible for the disability tax credit, the annual amount was $11,000. 1/40 of that is $275. Now, if the higher income spouse is eligible to make a claim, then they would make the claim first, and then the lower income spouse's claim, once again, that would be the lesser of those 3 amounts, would be reduced by how much the higher income spouse claimed. Any unused amounts do not carry over. So if there's not enough income, then those unused amounts are lost. They do not carry over to other years. On the next slide, let's talk about spousal and child support. Now, if you are paying the spousal support, that is deductible under 3C. If you're receiving the child support, if you're receiving the spousal support, then that is taxable. So spousal support is deductible by whoever is paying it, and it's taxable to the recipient in 3A. Now, child support is neither deductible or taxable. Child support, you cannot deduct it if you're paying it. You do not have to include it in income if you're receiving it. However, there's a rule that says that if the payer does not make the full amount of payments for child and spousal support, then the amounts are first designated as child support, and any remainder is designated as spousal support. So let's take a look at this example. Let's say that the spouse is required to make $200 per month of spousal support and $500 per month of child support. And so Jordan is required to pay Miles $200 a month for spousal and $500 a month for child support, but in this particular year, Jordan only pays Miles $7,000 for the entire year. So pause the video here and see if you can figure out how much will be designated as child support and then the remainder to spousal support. So pause the video now. Okay, let's look at the answer. So remember we said that if the full amount is not made, then the amount is fully designated as child support first. So the child support requirement is $500 a month times 12 months. So of that $7,000, $6,000 is designated as child support. Jordan would not be able to deduct that because remember, child support is not deductible. And it's only the remaining $1,000 that would be designated as spousal support. So Jordan would would only be able to deduct 1,000, and Miles, the recipient, would only have to include 1,000 in income. Let's move on to the next slide. Let's talk about registered education savings plan. Now, this is a way for parents and grandparents to start saving for their child's or grandchild's post-secondary education sooner rather than later. There's a maximum of $50,000 over the lifetime that can be contributed to a child's RESP. So this is a total of $50,000 per child. So if both the parents and the grandparents want to contribute, they need to make sure that over the lifetime of the RESP, that the total contributions by the parents and grandparents do not exceed $50,000 per child. Now, the amount that's invested can be split up over a number of years. It doesn't have to be $50,000 all at once. And when the amount is contributed into an RESP, that money can be invested in GICs, term deposits, maybe mutual funds, and all those accumulated earnings, while it's in the RESP, do not attract tax. So if a parent invests $10,000 into a child's RESP, and that money is invested in a term deposit and earns, let's say, $1,000 worth of interest income, that accumulated earning is tax-free while the money is in the RESP. When the money is taken out by the student when they go to post-secondary education, then the student needs to include those earnings in his or her income. And because the student is going to post-secondary education, they may not be earning any other income, so they may pay low or little tax on that. Now, the government will also make a contribution as well. That's known as the Canadian Education Savings Grant. And the government will contribute every year up to 20% of the amount that the parent and grandparents contribute, to a maximum of $2,500 of contributions per year times 20%. So up to a maximum of $500 a year, the government will add to the child's RESP. Now, the lifetime maximum is $7,200. Now, because the government will only contribute 20% up to a maximum of $2,500 contributions per year, the parents and grandparents should spread out their contributions, though, in order to maximize the amount of the CESG. Now, up to 1,000 of unused CESG contributions may be carried forward as well. There's also some incentives for low-income families. There's an additional CESG available for families that have low net income, and also there's another amount called the Canada Learnings Bonds as well, available for low-income families. Moving on to the next slide, let's go through this example. Let's say Ellen was born last year and her parents established an RESP. The parents, over the next 16 years, contribute the $50,000 maximum into the RESP. And let's say over the 16 years, the government contributes through the Canada Education Savings Grant. And let's say that the CESG contributions by the government also reach the maximum of $7,200. Now, the $50,000 that was contributed by the parents over those 16 years, let's say had accumulated earnings of $10,000. So once again, the parents contribute the amount, the government contributes the CESG. Once the money is in the RESP, that money can be invested in different types of investments, term deposits, mutual funds, exchange traded funds, and those accumulated earnings, let's say over the 16 years, total $10,000. Now, when the parents make the contributions, those contributions are not tax deductible. The CESG amounts, the amounts that the governments contribute, are not taxable at the time they're added to the RESP. And the accumulated earnings are not taxable at the time those earnings are made. Now, at this point, the total value of the RESP is $67,200. The $50,000 by the parents, the $7,200 by the government, and the $10,000 in accumulated earnings. Now, let's say Ellen goes to post-secondary education and withdraws $10,000 to pay for her tuition. And let's say that that $10,000 is comprised of $6,000 of the original contributions that the parents contributed. That amount is returned tax-free to Ellen, because the parents would have had to have paid taxes on their earnings before they contributed to the RESP. So when Ellen gets a return of the parents' contributions, she does not have to pay tax on that. The additional $4,000 is considered education assistance payments, and that would be a combination of the accumulated earnings and the amount that the government had put in. That $4,000 would be taxable to Ellen. Now, when money is taken out of an RESP, the institution that the money was invested in would indicate how much was from original contribution and how much is considered education assistance payments. Let's go through a different example on the next slide, and let's talk about tax-free savings account. Now, tax-free savings account may be established by any resident individual over 17 years of age. Now, there's limits for the annual contributions, and they've changed from year to year since they were introduced in 2009. So see your textbooks for what those annual contributions are. If an individual does not make a contribution one year, that amount will carry over to the next year. Now, the earnings accumulated tax-free in the TFSA. Because the earnings do not need to be recorded as income and there's no tax on that, that's referred to as tax avoidance. That's an acceptable way of tax avoidance. That's unlike RRSPs. RRSPs are a form of tax deferral. If an individual contributes to an RRSP, they get a deduction today. They don't have to pay taxes on that amount today. But when the individual takes the amount out, let's say at retirement, they will have to pay tax then. That's tax deferral. Tax-free savings account, any earnings on the tax-free savings account contributions are free of tax. So they avoid tax altogether. Now, if an individual takes money out of a tax-free savings account, they can add that amount back into their tax-free savings account in the following year. So let's have a look at this example here. This individual contributes and invests $5,000 into a tax-free savings account. Let's say that that investment grows to $10,000. Now, once the money is put into the tax-free savings account, that individual can invest in term deposits, mutual funds, exchange-traded funds, and let's say that that $5,000 investment grows to $10,000, and then he withdraws the full $10,000. Let's look at the analysis at the bottom here. The $10,000 will not be subject to tax. Now, in the following year, if the individual wants, they could contribute that $10,000 back to the TFSA in the following year or in any subsequent year, plus whatever annual amount they're allowed to contribute. So that's an example of tax-free savings account. Moving on to the next slide, let's talk about non-arm's length transfers of property. Now, when we talk about non-arm's length, we're usually referring to taxpayers that are related. So if there's a transfer of property from siblings, they're related, that's considered non-arm's length. Now, there's a rule that says if the disposition of property between non-arm's length parties are done not at fair market value, there is a rule that says the proceeds of disposition and of the transferor and the recipient transferee's adjusted cost base are adjusted. So let's take a look at this example here where it could lead to possible double taxation. So ITA 69, Income Tax Act Section 69, is where these rules for non-arm's length transfers at amounts other than fair market value are contained. In this example, the transfer is done below fair market value. John has a bunch of securities with an adjusted cost base of $200,000. The fair market value on the date of transfer is $350,000. He's going to sell them to his brother for $250,000. Maybe he doesn't want to recognize such a big capital gain, so he says, I'm just going to sell them to you for $250,000 rather than the fair market value of $350,000. Now, under Section 69 in the analysis, John is deemed to have sold them at fair market value. Doesn't matter the fact that he only sold them for $250,000. He's deemed to have sold them for $350,000, so he cannot avoid the capital gain of $150,000. Now, the brother, though, will only get an adjusted cost base of $250,000, what he paid for them. So John must record the capital gain as if he sold them for fair market value of $350. However, the brother will only get to record the cost of the securities at $250. So once again, it leads to double taxation. Let's go on to the next slide. Here, the transfer is done above fair market value. John, once again, has securities. The securities have a cost base of $200,000. The fair market value is $350. He's going to sell them to his brother for an amount above fair market value. Let's say John has some losses that he wants to utilize, so he wants to create a larger capital gain. So he sells them to his brother for an amount above fair market value. Now John is deemed to have proceeds, the actual proceeds of $500,000 minus the cost of $200,000, so he's going to report a capital gain of $300,000. Now the Income Tax Act says, well, even though you sell them for an amount over $500,000, the brother is deemed to have a cost equal to fair market value of $350,000. So the brother basically has lost $150,000 of costs. He paid $500,000, but he will only get cost equal to fair market value of $350,000. So once again, leads to double taxation. Moving on to the next slide, let's talk about tax-free transfers between spouses. Under Income Tax Act subsection 73(1), it allows for the tax-free transfers of property from one spouse to another. Now this can be done for survivorship purposes, and so the government says if one spouse wants to transfer property from one spouse to another, we'll let them do it on a tax-free basis. This way, there's no immediate recognition of any capital gain or recapture if it's a depreciable asset. However, the taxpayer may elect out of this tax-free transfer provision if they want to trigger a capital gain or recapture. Maybe the taxpayer has some losses that are about to expire, so maybe they want to trigger a capital gain or recapture. But let's just focus on if they do want to transfer the property tax-free. This is what the result will be. The transferor will get proceeds equal to the adjusted cost base, so there's no gain. For depreciable assets, the proceeds will equal the undepreciated capital costs, so there'll be no recapture. Now for the transferee, the recipient, if it's a non-depreciable asset, such as land, the cost will equal the original cost base of the transferor. For depreciable assets, the UCC that they recorded at will equal the transferor's UCC, and the capital cost will be the same as the transferor. So in this situation where there's a tax-free transfer, all the amounts would just transfer over to the recipient spouse. Moving on to the next slide, let's talk about non-arm's length transfers of depreciable assets, let's say between siblings. Now, if the transfer is done between siblings, the transferor may have a capital gain and only one half of that will be taxable. There's a rule that says the transferee, the recipient then, will have a limit as to how much they can add to the undepreciated capital cost if it's a depreciable asset. So let's take a look at this example here. An asset with a capital cost of $200,000 and undepreciated capital cost of $125,000 is sold for, let's say, fair market value of $250,000 from Jane to Sarah. And let's say Jane and Sarah are siblings. So the seller, Jane, in the analysis, has a taxable capital gain of $25,000. So Jane sold the asset for $250,000. It had a capital cost of $200,000. So there's a capital gain of $50,000, but only half of that is taxable. So the taxable capital gain is $25,000. And in the CCA class, the UCC is $125,000. A deduction of the lower of cost or proceeds is made, which is, in the case, would be $200,000. So Jane also has recapture of $75,000. Now, because this is done at non-arm's length, this is between siblings, the purchaser, Sarah, for CCA purposes, will only be able to add $225,000 to the CCA class, not $250,000. And that is because Jane only had to account for half of the capital gain of $50,000, only taxed on $25,000. So once again, there's a special rule that says if there's a transfer of depreciable assets between related parties done at non-arm's length, and the seller has a capital gain and only half of that is taxable, then the buyer, for CCA purposes, cannot include the full amount in the CCA class. It's the original cost, the $200,000, plus 1/2 of the taxable capital gain. In this example would be $225,000. That brings us to the end of this Chapter 9 tutorial. Now, some other topics that might be covered in the textbook, make sure you review those on your own: pension income splitting, registered disability savings plan, and income attribution rules. Now, as with all chapters, make sure that you do the textbook problems for extra practice, and all the material in the chapter is covered, so make sure you read the entire chapter, as that is all examinable. Good luck with your studies, and we'll see you in the next tutorial.